Alrighty, in this video, we're going to be talking about asset purchases on the three financial statements. And it's the seventh of the baby series and 15th on accounting, right? And the really important thing to understand here is that what is the difference between operating expenses versus capital expenditures? Right? And this is a really important thing for you guys to understand, right? An operating expense is like the salaries that you have to pay out. It's the like the light bill. It's like the utilities, right? That's what we're thinking when we're talking about operating expenses. These are expenses related with operating the business at its current state. Capital expenditures are otherwise investments that you make in the business, right? So let's say that I have a cookie factory, right? And I have different expenses related with that cookie factory. I have to pay the salaries of the employees that work there. I have to pay for like the energy and all of those other things, right? Those are all operating expenses. However, if I go and acquire a new factory or I go and acquire a new piece of equipment, right, basically investing in the business, right, that is a capital expenditure. And why does this matter? This matters because our operating expenses are on our income statement. And our capital expenditures are not on our income statement, right? So this is a really important distinction to kind of keep in mind. So let's go through an example and hopefully that makes it a little bit clearer. So let's say that we purchased a factory worth $100, or we paid $100 for this factory, right? And there's a 25% tax rate. Let's see how that impacts our three statements. We have to keep in mind when we're looking at the income statement that we are purchasing a factory. This is not an operating expense. Our operating expenses would be that our administration costs went up or something like that, right? It's not that we purchased a factory. That's not going to be included in our P&L. Now, so we move over to our cash flow statement. On our cash flow statement, under cash flow from investing, we're going to see our PP&E, which is our plant, property, and equipment, right? A factory falls under that, right? Be adjusted by 100 because we paid $100 of cash in order to purchase this factory, right? So what does that do with our overall cash? Well, our overall cash adjusts down by 100. Now we move over to our balance sheet. So under our assets, what happened here? Well, our cash went down by 100. However, our PP&E, that went up by 100, right? Now we own a factory worth $100. So with that, was there any change to our liabilities or our shareholders' equity? No, right? So we can see in our formula, assets equals liabilities plus shareholders' equity, we had a negative adjustment of our cash balance, and we had a positive adjustment for our PP&E, meaning that this still holds, right? So that's the main thing to kind of keep in mind whenever you're purchasing an asset, right? And how that's going to affect the three statements. At the end of the day, that's not going to be something that is on our income statement because that is not an operating expense, right? So operating expenses are very different from capital expenditures. And on our cash flow, there is likely going to be a line under capital expenditures, right? So you can put it under that, you can put it under PP&E, right? So that's the main concept here, understanding that there is a difference in treatment of capital expenditures versus our operating expenses. So hopefully that's been helpful. We'll hop into the next one.